Hey folks, welcome to a product review at Finominal. Today we're going to look at one of the largest and oldest mutual funds globally, specifically the Wellington Fund. Now the Wellington Fund was launched in 1929, so it has a history of almost a century, and the Vanguard Wellington Fund family manages more than $120 billion, making it one of the largest funds globally. So let's investigate in terms of what makes this fund so successful. And we're going to kick off with a simple benchmarking exercise. Now, our auto suggest benchmark is the US 60/40 portfolio, which is 60% allocation to equities and a 40% to investment grade bonds. The portfolio of Vanguard Wellington provides exposure to equities and bonds, right? So the benchmark seems appropriate. And we can look at the track record going back to 2003, where we do see that the Wellington Fund has nicely outperformed this benchmark portfolio. We can also see that from a Sharpe ratio perspective, it has achieved a higher one with 0.63 versus 0.57. So that's nice to see that the risk-adjusted returns were higher as well. From a portfolio perspective, if we look at the fact sheet of this fund, we would see that split around 70% to equities, 30% to fixed income. Having said that, from a risk-based perspective, it's all equities risk. In terms of breakdown by market caps, we see it's primarily large companies, and from exposure to countries, it's primarily the United States. Now, given that this fund manages more than $100 billion, they have no choice except to invest in US large caps from a liquidity perspective. Next, let's have a quick look at the factor exposures. And this is a fund that does not change much. So we can see the consistent exposure to the S&P 500, to US bonds. We do see occasionally negative exposure to US dollar index, which simply indicates exposure to international stocks or bonds. And we also see that there was no consistent investment style from a equity factor perspective, except perhaps value, which seems to be slightly positive. Having said that, if you look at this from a risk sources perspective over time, we do say that most of the risk is simply explained by the S&P 500, and exposure to equity factors is minimal. And again, that's just a reflection of largely allocating to US large caps because of the size of the fund, right? And equity factors just not being meaningful. From an alpha perspective, we have seen earlier that the fund has outperformed its benchmark portfolio, but alpha for us means the unexplained return. And what we do see is that this fund generated alpha in 14 out of 22 years, which is pretty good. Having said that, if you look at the cumulative return contribution, we of course see that the stock market has contributed most of the returns over the last 20 years or so. But we also observe that the cumulative alpha went from being meaningful to close to zero. And this has been quite dramatic over the last 3-4 years where the alpha just completely went away. Now, we could look at this fund versus peers, but there's something much easier we can do because now we've seen that the alpha of this fund has kind of like disappeared, right? And we can simply change the time frame to see how this fund has done in more recent periods. And if we constrain our period to the last 10 years versus the same benchmark, we observe that effectively the fund has underperformed. And so this kind of simply implicates, right, that if you're running north of $100 billion, right, you're very much constrained with regards to generating outperformance. And in fact, the last few years have been quite tough on this fund in terms of it starting to underperform. And that already concludes our review of the Vanguard Wellington Fund, which, as discussed earlier, has a long-term or impressive long-term track record, but given that it's grown so large, it's become very much index-like, and unfortunately also has started to underperform its benchmark. And with 17 basis points versus this simple portfolio comprised of the S&P 500 investment grade bonds, which you can replicate with like SPY and AGG, right, for 7 basis points, has just puts this fund into an unattractive positioning. So it's still been living off its past, right, which is good, but it's simply too large to provide value going forward. Hope that helps. Have a nice day.